Hello, and welcome back to the channel. I'm Algabot, and this is where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. Today, we're studying a strategy called Volatility Band Pin Reversal. It's a conservative mean reversion approach that watches for a rejection candle, a pin bar, forming right at the edge of a volatility band. By the end of this video, you'll understand the indicator that drives it, the three conditions that must line up before it acts, and exactly how it manages its stop and its target. Remember, this is educational information only and not financial advice. Let's dive in. So what exactly does the Volatility Band Pin Reversal Expert Advisor do? At its heart, this is a mean reversion strategy. That means instead of chasing a trend, it looks for moments when price has stretched too far from its average and may be inclined to drift back toward the middle. To measure that stretch, the strategy builds a volatility band. The center line is a simple moving average of recent closing prices, and around it sit two outer rails, placed a set number of standard deviations above and below that average. If you've seen Bollinger Bands before, the idea will feel familiar. When price wanders out to one of those outer rails, the strategy considers it overextended. But here's the important part, and what makes this version more careful than most. It does not fade the band blindly. A lot of simple reversion systems short every touch of the upper band and by every touch of the lower band, and they get caught out the moment a genuine breakout arrives. This strategy adds two extra layers of confirmation. First, it waits for an actual rejection candle, a pin bar, where price pokes past the rail and then closes back inside. Second, it checks that the market is in a balanced, range-bound regime by confirming the moving average itself is essentially flat. It deliberately steps aside when the average is drifting because a trending mean is exactly where reversion trades tend to fail. In terms of who it's designed for, this is an educational example of a patient, selective style. It waits for several conditions to align rather than taking every signal. As always, trading carries real risk, and losses are part of the process. Nothing here is a promise of any outcome. Let's walk through the mechanics step by step. On every new bar, the strategy works with the most recently closed candle, never the one still forming. First, it constructs the volatility band. It takes the last 20 closing prices by default and calculates their simple moving average. That average becomes the middle line, or the mean. It then measures the population standard deviation of those same closes, multiplies it by the band multiplier, which defaults to 2.2, and adds and subtracts that from the mean to create the upper and lower rails. Now the three conditions. Condition 1 is overextension. For a long setup, the low of the closed candle must pierce below the lower rail. For a short setup, the high must poke above the upper rail. Condition 2 is rejection. The candle must close back inside the band, and it must be a genuine pin bar. On a long, that means the lower wick has to be dominant, at least 1.5 times the size of the candle's body, and it must dwarf the upper wick by the WickDominance ratio. The close also has to finish in the upper half of the candle's range. The short setup is the mirror image, with a dominant upper wick and a close in the lower half. Condition 3 is the balanced regime filter. The strategy compares the mean now to the mean 10 bars earlier, and only proceeds if that drift is smaller than a set fraction of the current ATR, by default 0.6. In plain terms, the average must be flat. If it's sloping, the strategy stands aside. When all three align, and no position is already open, the entry is placed. On a long, the stop loss sits just below the rejection wick, with a small ATR buffer added for breathing room, and the take profit is set at the mean, the middle band. On a short, it's flipped, with the stop just above the wick and the target back at the mean. The logic is simple. A balanced market revisits its average often, so the exit aims for that repeatable move, while the stop closes a failed trade quickly. Let's look at the actual MetaQuotes code the expert advisor runs. At the top are the input parameters. Band period sets the window for the moving average and the standard deviation. Band multiple controls how wide the rails sit, in standard deviations. WickBodyRatio and WickDominance define how pronounced the rejection wick must be, both against the candle's own body and against the opposite wick. Slope lookback and SlopeMaxAtr form the flat regime filter, and ATR period and stop buffer ATR handle the stop sizing. Lots is the fixed trade volume. Now the long block, labeled bullish pin at the lower rail. You can read the conditions in sequence. The low is below the lower band. The close is back above it. The lower wick beats the body and the upper wick by the required ratios, and the close finishes above the candle's midpoint. When all of that is true, the code sets the stop just beyond the wick low, sets the take profit at the mean, and calls trade.buy. The short block, labeled bearish pin at the upper rail, is the exact mirror. The high pierces above the upper band. The close is back below it. The upper wick dominates, and the close sits below the midpoint. Then it places the stop just above the wick high, targets the mean again, and calls trade.sell. Notice that both sides always aim the take profit at the same middle band, and both keep the stop tight against the rejection wick. Now let's bring it all together on a chart. What you're looking at is a range-bound market in the euro against the dollar. The three colored lines are our volatility band. The gold line in the middle is the moving average, the mean, and above and below it sit the upper and lower rails, each placed a set number of standard deviations away. Notice how flat the middle line is across the whole screen. That flatness is exactly the balanced regime the strategy needs, so its filter is satisfied throughout this example. Watch the opening candles. Price is drifting gently lower, ticking down from the middle of the band toward the lower rail. Each candle closes a little beneath the last, but nothing dramatic, just a slow slide within the range. Then we reach our setup candle. This one dips sharply. Its lower wick spikes down and pierces clean below the lower rail, marking an overextension. But look at where it closes. Instead of finishing down at the extreme, price is rejected and pushes back up, closing back inside the band, in the upper half of the candle's range. That leaves a long lower wick and only a tiny body, a classic pin bar. The lower wick dwarfs both the body and the little upper wick, satisfying the wick dominance rules. All three conditions are now aligned: overextension, rejection, and a flat mean. The buy entry marker appears. The stop loss is tucked just below that rejection wick, with a small ATR buffer, so if price keeps falling the trade is closed quickly. The take profit is set at the middle band, the mean. Now follow what happens. The candles after the pin bar begin to climb back toward the center of the range. This is the reversion the strategy is built to capture. Price works its way up, one candle at a time, until it reaches the middle line and the take profit marker prints. The long trade is complete, closed at the mean, exactly as designed. But the market keeps oscillating, and now it hands us the opposite setup. Price continues upward past the mean, drifting toward the upper rail. Then comes the second key candle. Its upper wick surges up and pierces above the upper rail, another overextension, this time at the top. And again, the extreme is refused. Price closes back inside the band, in the lower half of the candle, leaving a dominant upper wick and a small body. That's a bearish pin bar at the upper rail. Overextension, rejection, flat mean, all three conditions line up once more. The sell entry marker appears. This time the stop loss sits just above the rejection wick, and the take profit is set back down at the middle band. From there, price rolls over and begins sliding back toward the center, just as it did on the long side, only mirrored. Candle by candle it works lower, back toward the mean, until it reaches the middle line and the take profit marker prints again. The short trade closes at the mean. Notice the symmetry of the whole cycle. Both trades started at an outer rail. Both waited for a genuine rejection candle rather than a blind touch. Both required the mean to stay flat, and both targeted the same middle band. The reward-to-risk profile comes from that structure. A tight stop just beyond the wick, and a target at the average that a balanced market tends to revisit. Of course, not every pin bar leads to a clean reversion. Sometimes price pierces the rail and simply keeps going, which is why the stop is placed so close, and why the flat mean filter is there to keep the strategy out of trending conditions in the first place. This is an illustration of the logic, not a prediction of what any market will do next. And that brings us to the end of our breakdown of the Volatility Band Pin Reversal Expert Advisor. We covered how it builds a volatility band from a moving average and a standard deviation, how it waits for a pin bar rejection at the outer rail, how it filters for a flat, balanced market, and how it manages every trade with a tight stop beyond the wick and a target back at the mean. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading involves real risk, and losses do happen. If you found this useful, please like the video, leave a comment with the strategy you'd like us to study next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.